We've all seen those headlines that just make you pause, right? A company reports this huge loss, but then its stock price actually jumps. How does that even happen?
It definitely seems counterintuitive at first glance.
Totally. And today we're digging into exactly that paradox with Circle Internet Group, ticker CRCL, looking at their Q2 2025 earnings. And this is, well, it's a really pivotal one. It's their very first report as a public company.
Big moment for them, yeah.
So our mission here is to unpack their official numbers, mix that with what the market was expecting, and use this really cool structured framework, actually, the one you, our listener, shared with us, to cut through all the noise.
Get to the real story.
Exactly. Find those aha moments. And this isn't just about Circle, It's about learning a method to analyze any earnings report to get beyond just the headlines. So we'll go through this section by section using that framework.
And that structure is so important, especially, like you said, for a company just going public. Those headline numbers, particularly a big loss, can be, well, seriously misleading without context.
Right.
You really have to dig deeper to see what's actually going on with the business health. Understanding the why behind the numbers is everything.
Couldn't agree more. Context is key.
Yeah.
Okay, let's dive in. Now for slide 1, the at-a-glance scorecard. So looking at this first slide, Circle's debut report, it looked like a mixed bag, maybe. They beat on revenue, which sounds great.
Yep, solid beat.
But then, bam, a GAAP-diluted loss per share of negative $4.48. That sounds pretty rough for a newly public company. What did the market see that made them kind of shrug off that big negative number?
Yeah, this is where it gets really interesting. It shows how markets, can look past the surface. So Circle reported total revenue and reserve income of $658.1 million. That easily beat the Wall Street consensus, which was around $644.7 million.
Okay, so a clear beat there.
Definitely. But yeah, that GAAP-diluted loss per share of negative $4.48 did miss estimates. But here's the kicker. CRCL stock climbed almost 8%, 7.9% to be exact, in pre-market trading right after the announcement on August 12th.
Wow.
And the initial analyst talk, overwhelmingly positive. They focus right on that revenue beat and the real aggressive growth in their USDC stablecoin.
Yeah.
They basically dismissed the GAAP loss, calling it out as like one-time IPO stuff.
Makes sense. So break down those core numbers for us again.
Sure. So total revenue reserve income, like I said, $658.1 million this quarter. That's up a strong 53% from $430 million in Q2 last year.
Nice growth.
Really nice year-over-year growth. But net income, that swung hard from a $32.9 million profit last year to a $482.1 million loss this quarter.
Oof.
Yeah, and the diluted EPS followed right along from 0 cents last year to that negative $4.48.
So why did the market cheer that loss? Walk us through that again.
Right, this is the core of it. It boils down to two main things messing with that GAAP EPS number. First, the numerator, the net income itself. That negative $482 million loss was, and this is the key phrase, significantly impacted by IPO-related non-cash charges totaling $591 million.
Non-cash, okay.
Exactly. These weren't dollars going out the door for operations. They were accounting requirements. The big ones were $424 million in stock-based compensation that vested, because of the IPO.
Oh, okay.
And another $167 million non-cash charge because the value of their convertible debt went up, which ironically was partly because Circle's own share price outlook improved.
Huh. So good news causing a paper loss.
Kind of, yeah. Investors saw these as one-off things, purely related to the IPO event, not a sign the underlying business was struggling. It's a classic case where strict accounting rules don't quite capture the immediate, operational reality.
Got it. And the second factor?
The second factor was the denominator, the number of shares. An IPO means issuing new shares, right? So the weighted average diluted shares used for the EPS calculation jumped over 50%. From about 70 million to 107 million.
Dilutes the per share number.
Exactly. More shares spreading that loss out makes the per share number look worse. And just quickly, when we say diluted EPS, we mean it includes potential shares from things like options or convertible debt. Basic EPS just uses common shares. In this case, because it was a loss, basic and diluted ended up the same share count. But the point is the share count increase was huge.
Okay.
So bottom line, the market basically ignored that messy GAAP EPS number. They focused on the real revenue beat and the underlying growth story. They saw it as a strong start.
That makes a lot more sense. Understanding the why behind the numbers is just critical. Okay, let's pivot now to slide 2, the engine of profitability. So we just talked about that huge GAAP loss. But the report also highlights something called adjusted EBITDA, which was positive and growing. This really shows that chasm between GAAP loss and non-GAAP profit, doesn't it?
It really does.
Why do companies, especially right after an IPO, often use these non-GAAP metrics?
Yeah.
And what should we look for when they show us how they got there?
That's a great question. GAAP rules are, essential for consistency, but sometimes, especially around big events like an IPO, they can kind of mask the core operational performance.
Right.
So for Q2, Circle had that GAAP operating loss of $325.6 million and the net loss of $482.1 million. But their adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization adjusted for certain items, was a positive $125.8 million. And that was up 52% year over year.
Big difference.
Huge difference. And the bridge, how you get from that big GAAP loss to the positive adjusted EBITDA, is by adding back those specific large non-cash or non-recurring items we just discussed.
Like the stock comp.
Exactly. The company provides a reconciliation table. They have to, legally.
Hmm.
It clearly showed adding back about $435 million for stock-based comp and $167.7 million for that fair value change on the debt. By looking at adjusted EBITDA, investors get a clearer picture of the core profitability without the IPO noise.
And just for clarity, GAAP is the standard accounting rules, non-GAAP is management's view, and they have to show the math connecting the two.
Precisely. They can't just make up a number. They have to show the reconciliation from the official GAAP figure.
Okay. So how does this fit into their margins? The slide talks about investing in growth while showing leverage. What does that mean?
Right. Let's look at the margins. First, there's something called revenue less distribution costs, or RLDC, margin. Think of this as how much Circle keeps after paying partners, like Coinbase, for helping distribute USDC. That margin actually went down a bit, from 42% last year to 38% this quarter.
Down. Is that bad?
Not necessarily. It seems like a deliberate strategic choice. Distribution costs grew faster than revenue, meaning they're likely spending more aggressively with partners to really push USDC adoption and integration. They're sort of investing margin today to build a bigger network for tomorrow.
Okay, investing for the long term. Makes sense.
But here's the really fascinating part. While that RLDC margin tightened slightly, their adjusted EBITDA margin, which they calculate as a percentage of RLDC, actually expanded. It went from 46% last year up to 50% this quarter.
Expanded.
This shows powerful operating leverage. It means their net revenues, the RLDC, grew faster, 38% YoY, than their core adjusted operating costs, which only grew 29% YoY.
Efficiency.
Exactly. So as revenue grows, more of each extra dollar is dropping to the adjusted bottom line. That underlying efficiency, even while they're investing heavily, is something investors really like to see. It shows the business model scales well.
So they're spending strategically, but also getting more efficient underneath. That's quite the balancing act. All right, let's move on to slide 3, the engine room business segment performance. Okay, Circle reports as just one company, but the sources say there are really 2 different ways they make money, 2 revenue streams. What do these tell us about how their business actually works and, maybe more importantly, where they're trying to go?
Yeah, understanding these 2 streams is really fundamental to understanding Circle's engine. The first one, and it's the big one by far, is reserve income. In Q2, this was $634.3 million. That's like 96.4% of their total revenue.
Nearly all of it.
Pretty much. And it grew 50% year over year. The way it works is simple. Someone gives Circle $, Circle issues 1 USDC token, and they invest that dollar in safe short-term stuff like T-bills. The reserve income is just the interest they earn on that huge pile of reserves.
And that grows if USDC grows or if interest rates go up.
Exactly. The drivers are the average amount of USDC out there, which grew an amazing 86% year over year to $61 billion.
Huge growth.
And the interest rate they earn on reserves, the reserve return rate, that was 4.1%. It actually dipped a bit from last year because market rates change, but the massive growth in USDC circulation easily made up for it.
Okay, so that's the main engine. What's the other stream?
The second stream is called Other Revenue. It's much smaller right now, only $23.8 million in Q2. But, and this is key, it saw explosive growth, up 252% year over year.
252%. What's in that?
This comes from their platform products, things like subscriptions, fees for transactions, and services for businesses using their Circle Payments Network, the CPN.
So more like tech platform revenue.
Exactly. And this leads us to a really crucial strategic point, de-risking the business model. Relying so heavily on reserve income, almost 97% of revenue, makes Circle very sensitive to interest rates, right?
Yeah, if rates fall, that income shrinks.
Precisely. Even if USDC keeps growing, that's why that tiny slice of other revenue growing at 252% is disproportionately important. It's not tied to interest rates, it's tied to how useful Circle's platform is.
The more people use their tools and network,
The more that revenue grows, regardless of what the Fed does. And the press release showed they're pushing this hard, launching their ARC blockchain, getting over 100 institutions lining up for the CPN, partnering with huge players like FIS, Fiserv, Corpay.
I see it now.
So what it all signals is a strategic evolution. They're moving from being mostly about earning interest towards becoming a more diversified, full-stack fintech platform. Growing that other revenue is key to building a more durable, less rate-sensitive business, and probably getting valued more like a tech company long-term. It's a deliberate pivot.
That's a really clear explanation of a critical shift. Okay, let's dive into slide 4. Financial strength and shareholder rewards. Now, looking at Circle's balance sheet, honestly, at first glance, it looks kind of scary, like $64.2 billion in assets, but $61.8 billion in liabilities. That seems like a ton of debt. But the analysis calls it a fortress of segregated assets. How does that work? How can it be a fortress with so many liabilities?
Yeah, it's definitely not a typical balance sheet and it throws people off, but the vast majority of both those assets and liabilities are directly tied to the stablecoin. See the $61.4 billion asset line, cash and cash equivalents segregated for the benefit of stablecoin holders.
Segregated.
Exactly. And that almost perfectly matches the $61.1 billion liability line, deposits from stablecoin holders. So it's not traditional corporate debt like bonds or loans. It's basically customer money held one-to-one in reserves. The fortress idea comes from that segregation customer funds are protected and fully backed.
Okay, so that huge liability isn't really their debt in the usual sense. What about their actual corporate debt?
Right, to gauge their real financial leverage, you look at the corporate stuff. Their main corporate liability is about $206 million in convertible debt. You compare that to their stockholders' equity, which is a solid $2.37 billion.
Oh, the ratios.
It works out to a corporate debt-to-equity ratio of only about 8.7%. That's very low, very conservative. Plus, they have about $1.1 billion in corporate cash. So financially, they're actually in a very strong position.
That makes a huge difference. So what are they doing with that strength? The slide mentions capital allocation, a war chest for growth.
Yeah, so remember they just did their IPO in June. They raised $583 million in net proceeds from that.
Right.
Given their strong balance sheet already, they didn't really need that cash for paying down debt or covering losses. So it's essentially offensive capital. It's a war chest specifically raised to fund growth.
And what kind of growth?
Things like building out that new ARC Layer 1 blockchain they mentioned, expanding the Circle payments network globally, forging new partnerships, basically pouring fuel on the fire to accelerate USDC adoption and utility.
Makes sense. And I assume no dividends or buybacks yet.
No, and that's totally expected. For a high-growth company right after its IPO, especially when investing this heavily, you wouldn't expect them to return capital to shareholders yet. All the focus is on reinvesting every available dollar to capture market share and build out that long-term vision. Pretty standard playbook, really.
Got it. Strong foundation, investing heavily for the future. Okay, let's wrap things up by looking at slide 5, the road ahead management's outlook and key takeaways. So what did management actually say about the future? What does their guidance tell us about where Circle is heading and what their priorities are? Are they gunning for growth above all else? Or starting to focus on profitability?
Yeah, their outlook gives some pretty clear signals. They're projecting a strong 40% compounded annual growth rate, CAGR, for USDC circulation over multiple years through economic cycles vary. For this fiscal year, 2025, they guided other revenue, that key platform revenue, to be between $75 and $85 million. They see the RLDC margin landing between 36% and 38% for the full year. And adjusted operating expenses are projected between $475 and $490 million.
Okay, so what's the story those numbers tell?
Well, putting it together, the full-year RLDC margin target is a little below where they were in the first half, and the expense guidance suggests spending will ramp up in the second half of the year.
So reinvesting more.
Exactly. It strongly reinforces that strategic narrative we've been talking about. They are clearly choosing to reinvest profits and that IPO cash back into growth initiatives. Long-term platform building and market expansion are definitely taking priority over maximizing profits in the short term.
And the CEO sounded confident.
Yeah, Jeremy Allaire's comments in the release were very bullish. He said something like, "We are seeing accelerating interest in building on stablecoins and partnering with Circle across every significant sector." It really suggests they feel they have a huge opportunity right now and they're stepping on the gas.
Okay, so let's synthesize. What are the absolute key takeaways from this first public quarter?
All right, key takeaways. First, operational strength trumped accounting noise. The market absolutely looked past the headline gap loss and rewarded the real revenue beat and underlying growth. That's huge.
Definitely.
Second, the USDC engine is firing on all cylinders. That massive 90% year-over-year jump in circulation is the core driver. It shows incredible product market fit. Third, a strategic pivot to a platform model is underway. That 252% growth in other revenue, plus the investments in ARC and CPN, it's clear they're building a more diversified, less rate-sensitive fintech platform.
Makes sense. And the last one.
Fourth, a confident and clear path forward. Management gave detailed guidance, set ambitious long-term targets, and seemed to have a very transparent plan. Investors like that clarity.
So the final narrative.
The final narrative is that Circle's Q2 was, frankly, a very successful public debut. Investors clearly endorsed the core strength they saw and bought into the strategic vision, that big gap loss. It ended up being almost a proof point showing the market could tell the difference between a one-time accounting event and a genuinely promising operational story. They've laid a really strong foundation.
That's a fantastic summary. This deep dive really shows how using a structured approach can, cut through that initial confusion and really get to the why behind the numbers, even when they seem to contradict each other. So maybe a final thought for you listening. Think about how using this kind of structured approach, looking past headlines, demanding context, separating operations from accounting quirks, could really empower your own understanding of any company you look at. It could give you a real edge.
Absolutely. Knowledge is powerful, but applied knowledge is even better. We really hope this analytical mindset is something you can take away and use.
Please remember, this deep dive is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure accuracy, no guarantee is provided. This report was generated by an artificial intelligence model, integrating data directly from official earnings press releases and publicly available market data. All information, including financial data and calculations, should be independently verified by you before making any decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.